Hey guys, this is Viper SRT from 1DSP stock picks or $1 stock picks. I want to go over the best time intraday to be looking at buying a stock or selling a stock. You don't want to be going in at the wrong time of day and get caught in a trap. So I'm going to help you out by trying to figure this out. Alright, so to me, they always tell you not to buy at the open. Very smart. You shouldn't buy at the open. Reason being is if you look at the first bar, this goes up, but then it could easily go right back down below that bar. An example of that would be, let's look at one of these stocks here. Okay, so as you can see here at the open, it shot up to 105, but then after it went up to 105, it shot all the way back down here to 77, and then it didn't get back above 90. So if you bought here at 90, then you might almost break even. But if you bought up here at 95 to $1.06, then you lost a ton of money the very next 15 minutes. So your first 15 minutes you made money, the next 15 minutes you lost a ton of money. Okay, over with. Your day is dead, and you didn't even have enough time to really think about what was going to happen. So my best time that I like to look at a stock, I don't even like to open up my computer until 9:30, maybe 9 being the earliest, because let's see what 9 o'clock would have produced here. By 9 o'clock this stock would have told you you're in trouble, but that goes the same way with a good stock. So let's look at eCore real fast. Okay, so by 9:30 we hit this red bar. This red bar, as you can see, is at 2:30. So 9:30 it was sitting at 2:30, and then as you can tell, it took off from there. Okay, so I like to look at those things. Now another interesting thing is, let me do my screen drawing real fast, is if you look with the moving averages, this is kind of important because this can kind of tell you what it's going to do. If you see here, we have a triangle. If you see here, we have a triangle. Those are squeezes. Okay, so right here we had a squeeze, right here we had a squeeze, and as you can tell, it shot out of the squeeze. Now what I like to do is whenever we hit 9:30, I like to look for these squeezes in a stock. So what I'll do is I'll see that, hey, this is creating a pattern, a tiny little pattern. I want to buy somewheres in here. I want my stop loss to be right underneath it. If I lose, I don't lose much. If I win good, So just to prove that point, let's go look at some more stocks real fast. Let me get out of this. Discard. Okay, so we'll just go down the list. All right, 9:30. I probably wouldn't have bought this stock. It was 3 days up. It started to come down. I probably would have questioned if it was going to hold up. I probably would look at a different time frame, like maybe a day or a 4 hour or something like that, just to confirm what it was going to do. But right now we're on a 15-minute time frame, so I probably wouldn't have bought that one. What about ZSAN? And this one looks a lot better. As you can see, let's see where 9:30 is. 9:30, we're in a third pattern. So this one would have been a little skeptical, but I probably would have gone with it. So let me bring up my, let me move this out the way. Let me bring up my drawing tool here. Screen right. And as you can tell, we have triangle. We have the squeeze right there. They come out of the squeeze, we have the same thing, another triangle. and then out of it we come here. Now, this is actually the day before, so it started to show it squeezed the day before. So actually, I didn't see this gray stripe here. This is the pre-market, same as this pre-market. This is pre-market, post-market. But as we're coming into the next day, you can see we had a squeeze right there. Could have bought at 9:30. Put my stop loss at 160. Could have bought at 165, maybe even 170. I would have been, if I would have bought at 170 and it would have gone against me coming below my 160, I'd have been out 10 cents per share. Depending on how many shares you have, that can be expensive. Example of that, let's say you have 2,000 shares at, what was that, 160. We'll do 160. 2,000 shares times 0.01. So for every cent, if you have 2,000 shares, for every cent you're losing or gaining 20 bucks per share or per cent. Okay, so say you go up 10 cents, you're making $200. 20 cents, $400, or losing depending on how much, it goes against you. But let's see, we had 60, 70, 80, 90, so 30 cents. So at 2,000 shares, 30 cents, you would have walked away with $600 for the day. That would have been a great day. So depending on how you pay attention to the movements of the stock, can really determine. Now, a stock that I've been watching lately, and I'll just give an example of this, is GHSI. Okay. Now, we're going to go back a few days let's go to the 1 hour. So we're going to go back a few days here. And as you can see, the stock was trending, but then it started to kind of come down, and then come down some more. And then the last 2 days, it's come up again. Now, as you can see, we've created some squeezes here. We've had the main squeeze come up right here to start off with. And then after it shot out of that squeeze, it just kept going until it hit 75 cents. Once it hit 75 cents, it started to drop off a little bit. And then, as you can see again, it squeezed above that 75 cents, went up to 95 cents, and then that was its top. And then from there, it was sell-off. And these squeezes work the same way both directions. So, I'll show you here. We have the squeeze coming up here and the shootout. But on the opposite side, whenever it's about to go against you, you have kind of the same deal. It isn't exactly instant per se, but once you start dropping below your when you start dropping below your moving averages here, and then it starts to get below see, these are my short terms. So we've got the 20, 34, and then the 50. Those are my short term. And as you can tell, once it got below the 50, it kind of wanted to squeeze one more time, but here's the actual squeeze right here. You can see it, and it makes a triangle just like one going upwards. So you have here, and then the shootout. And as you can tell from there, it followed this 20. And then it followed it all the way until it got back down below 50. And once it hit 50 cents, then it started to move back up again. And as you can see, it created a squeeze in itself. So right here, we got our squeeze kicking. Now this can go against on the next day. This could always roll right back underneath it It'll roll up underneath these moving averages, hit them, and then roll out. This is kind of like the sin wave patterns that happen in stocks. And it happens all the time. It happens to every stock sooner or later, one way or another. And knowing when and how to watch for them can really make you a lot more profitable. That way you're not buying in wrong. But if you look for each day, let me go over this. If you look for each day, let me get it back up into we'll do 10-day 30 minutes. Okay, so if we look 9:30, if you bought at 9:30, you can see if you bought before that, then you had to wait, and you didn't know if it was going to be a performing stock or not. But if you bought at 9:30, for instance, right here, this bar, and you set your stop loss below that 9:30 bar, then you would have been really good that day. Same thing here. 9:30, you bought at the 9:30 bar, then you may have made some profit by 1 o'clock, but then you would have got probably stopped back out, later that day, around 2 o'clock. But in between that point, if you bought at 9:30, you didn't lose. You come back, you lost, but look, you didn't lose much. You lost a very tiny little amount if you did lose, if you put your stop loss right below your entry. Now let's go to another stock. Let's just be random. Alright, so boom, just hit this stock. 9:30, probably wouldn't have bought that one instantly, but I would have kept it on watch, because where I would have wanted to buy it would have been right above its initial high here. And as you can tell, you see this green line, and it's sitting there. That green line is your ORB. It's your open range bars. So basically this is going to get the 30-minute range. It's above the center of the middle range and up towards the top of the middle range. The red is below the middle range. The thing about those open ranges is if you hit below this red, and it'll just keep going down. You hit above the green, a lot of times it'll go up, and sometimes it'll continue to go, but sometimes it'll touch back to it before it goes up. Sometimes it'll come back into the yellow. You just got to kind of watch your stocks, because they move their own ways. Okay, let's go back over here. Just random. 9:30. I would have bought this stock. I think I looked at this one already. ZSAN. By 9:30, you still would have bought the lowest here, and then at the end of the day, you would have been a winner. Same thing here. 9:30 the next day, bought there, stop right below it, you would have been a winner. If this is just patterns, everyday patterns. 9:30, stop right below it. You can see this is the bar. 9:30, stop right below it, and then boom, it just took off. Intech, 9:30, you're below the averages, and as you can tell, this day would have done that. But if you would have seen anything on the scanner go around 11, then you could have said, hey, look, boom, 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 boom. So you just kind of got to watch. It's not perfect science. You're not going to be like, hey, 9:30 every day is going to give you the right, because you see, this is the bar right here. It's not going to give you the right answer every day. But as long as you're not buying at the open, because if you buy at the open, say I bought here at the open, I would have lost money, because it would have dropped down to 66. I would have bought at 72. You're losing almost 10 cents. I was like, but if I waited till 9:30, then guess what? That same day, if I would have bought at 9:30 versus at open, I would have actually been a winner. Wouldn't have been a big gain, but I would have been a winner. I would have bought at 65, and then I would have been able to sell at 70 or 68. But either which way, I would have made anywhere between 5 to 10 cents off of that particular play. Same thing on this day. Look at this. Bought at the open, you're buying at 74. Buy at 9:30, you're able to buy in at 70. So 3 cents per share. Now here is a good example of why you wait till 9:30, because so look here. If I would have bought at 9:30, I would have bought here, and I would have put my stop loss right below it at 80, or maybe I would have bought it at 82, had it at 80, but then look, it rolled out. It left you the train. But if I wouldn't have put that stop loss right there, it's at 80, when I'm buying at say 82 or whatever, then I would have lost more than 2 cents per share. I would have lost for almost 8 cents a share, 10 cents a share, and as you can see before in the last example, whenever I did the math, 2,000 shares times 10, you're looking at losing $400, so that's just some examples of, why you should wait, at least till 9:30, 9:45, 10 o'clock before you buy a stock. You can't guarantee what it's going to do out of the gate. There's a lot of volume, a lot of indecision, and you don't know whenever a company is going to move out of it. So like you have, you got us private investors, but you also got the big players that come in, these institutions, and these institutions, could drop you just like this, drop you like a ball. It's not going to hurt them. They're going to lose, maybe $50,000 right there. Oh, no big deal. We're just going to hold it and hold it and hold it until we make our money back. And they will. They'll hold it for months on end, where you can't afford to hold it for months on end. You don't have the cash to say, if this thing hits 0, I can handle that loss. You don't have not only the cash flow, but the income coming in the same way that financial institutions have. They constantly have revolving money, so even if they lose money, they're still gaining money, and then those go into other investments, and if one investment's losing, another investment's gaining, it balances itself out. With us, if we're day trading, we're sticking to 1 or 2 stocks. If we're on low accounts, we're really sticking to 1 stock, and if you do this, though, you can do your day trading so much smoother if you're on a small account, because, hey, look, I'm not losing a whole lot here. I'm losing between, a few cents per share, and I can put my whole account on it, and I can ride the wave, and come out with a good profit for the day. And then as those profits continue to build and build and build, you get more and more capital to work with, and then you're able to make better and better trades, especially as you get used to the patterns and the way that it works. Now, my moving averages I have here, just so I can go ahead and clarify this for you. We have the green is 20, the yellow is 34, and the little red is the 50. I should change that color, though. The bigger red is 200, and then you've got the 100. So I've got 200, 100, 20, 50, and 34. Now this is just one of my setups. I have several setups, like this one right here. It's pretty much the same thing, just slightly different. It's missing the 200 and the 100. This is just the 13, 20, 50, and I guess that's 100. Another one that I have, you can see I have a lot more here, and these actually can be pretty interesting. Let's put it on the 1 hour. This one uses the, what do you call it, the moving the exponential ribbons along with the moving averages. That can give you a little bit different view, because as you can see where the stock dropped out, over here, you can see this strong shift on the bigger moving averages as they move down, and as you can tell, the price just continues to move down with these bigger averages. And what's good about that is when you get above these bigger averages, then a lot of times they like to either test them, shoot through them, or bounce back down out of them and go the opposite back down. So those become good areas to know, hey, watch it. If I'm up into these little zones here of these larger moving averages here that are longer term, then the second I hit them, I'm either going to shoot down and lose, and it's going to go back to say 70 cents or whatever, or it's going to shoot out and we're going to be up in the 95 to $1.50 area, because as it gets above these averages here, then it wants to get up to the prices that originally was before it went through those averages. And as you can tell, also they create squeezes in those too. So as you can see here, we have a squeeze, and as it shot out the squeeze, it gave you pretty good profit there. So this is just some tips. I hope it helps you. I hope you can see the market better. Remember, don't hold anything too long, because everything that goes up must go down, and everything that goes down must go up. So over time, it will do one or the other, either which way. So you protect yourself by timing. You time yourself in, you time yourself out. You don't hold too long. 2 days, 3 days max, on any stock that you're holding. If it gives you some more after those 2-3 days, then you jump back in and you hold that wave for that long. If you hold for too long, then you may go, as you can see here, just give you an example. You may come up and you're thinking, yay, 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 but then boom, all that you just gained on here is all back gone. So this whole section of profit is gone. So never hold too long. Always make sure that if you're in profit, once you're in profit and you're doing good in profit, when you see it start to crash into these your shorter term moving averages, like as you can see here, it came up, it crashed into it, it went up, it crashed into it, went up, it crashed into it, but then it dropped down. You sell that drop down. If you've already been up, you sell that drop down, because if not, it's just going to continue to take your money back. So just remember that. Don't ever hold once you see it crash from the shorter moving average back down below it. Once it crashes below it, sell. Don't waste your time. Don't hold. Don't bag hold. Sell. Get rid of it. Start over. Look for your next pattern. That's how you stay profitable. You go from one pattern to the next pattern to the next pattern. You don't hold. If you want to do long-term holds, buy something that hit its 52-week low, and let it ride until it's coming off that 52-week low. Stay away from 52-week highs. Everybody thinks, hey, let's jump on a 52-week high. No, you don't mess with a 52-week high. Once it hits the 52-week high, it's most likely going to come back down. Highs have to come down, lows have to come up. Even though lows can still continue to go lower and lower and lower and lower. I mean, you can go below even a penny, into tenths of a penny, so. But this is some tips on movement, because this is what stocks do. They move, and you've got to pay attention to movement and how they're going to move. So I hope this helps, guys. I know I rambled a lot. I know I talked a lot. I'm not a financial advisor. So this is just me showing you how to move a stock. It can show you your potential profits, potential losses, and do know that everything that you do in the market is a gamble, but you can have the odds on your side if you focus and you pay attention and you buy right and you buy at the right times. So keep this in mind. I'll probably share these settings later that I showed y'all, whether on my moving averages. I know that moving averages can be pretty simple in theory, but really, say I just have one moving average on there, like a 200. Most people say, hey, let's just throw a 200 on there. Let me get into when they don't have nothing on it, or has barely any on it. Oh yeah, I changed that one, didn't I? We'll just empty this one because this one's not as useful. I mean, it is useful, but it's not as useful. Plus, I can always put this back on there at any time. Ooh, it's giving me trouble. Delete. Alright, so we're going to put a Alright, so we're going to put a 200-day moving average on here. Just one. Alright, and as you can see, it gives you something. Let me put on a 1 hour. It gives you something, but it doesn't give you enough to make a choice every day. Now, if you wanted to go without moving averages at all, you could easily. Because you could say, hey, look, I don't buy at the open, I buy at 9:30. Well, by 9:30, say this day, you know, I mean, it's not showing me the 9, but if I showed you at 9 here, or 10, we'll just go with 10, then as you can see, probably around 9:30, it really was starting to come down into this spike, this little lower spike, and then from there, it wanted to shoot back up. Same thing here, around 9 or so, you could have bought here, and, you know, you wouldn't have lost much that day, but you would have lost, you know, but if you pay attention, hey, you know, we've come down, we've hit bottom, it's going to want to come off the bottom, may not want to go far because you got a 200-day moving average up here, you know, but you could do this daily without even, you know, a moving average in there. If I just put it on a 5-minute, had no moving average, let me just remove that altogether. No moving average, 9:30. I can say, hey, it's not one to go above 70. If it goes above 70, then it's going to be a winner. You know, so obviously by 11, hey, look, it got above 70. We went to 71, 72, 73, 74, 75, 76, 77, 78, 79, 80, 81. You know, so that's just, you know, one day. SRAX, let's just put a SRAX up. By 9:30, nothing. Of course, this is a bad example. INAP. Because I like a certain amount of movement in a stock. So, like, for instance, I like a stock that shows that it's moving up on volume. And the way that it shows that it's moving up on volume is just up, down, up, down, up, down, up, down. But if I waited till, say, just... Good morning. Just 9:30 here. Then I could have bought it 250 and then kept up to 270. So that'd been 20 cents a share. Alright guys, well my daughter just woke up and I wanted to share this with you, so I hope that this helps everybody, and you know, you can get an idea that, you know, you don't have to have moving averages to see a stock move. 9:30 is probably your best time to buy. I wouldn't look at a stock until 9 o'clock at all. I wouldn't even look at my charts. I wouldn't look at nothing. Come in at 9 and start your day. You know, figure out where you want to go from there. But this will really help your trading out quite a bit because you didn't buy at the open and you didn't instantly lose money. So just keep that in mind, guys. Well, you have a good day. Thank you.